Most people understand the general idea of saving money. Set some aside, do not spend it, have it available when you need it. But the mechanics of how saving actually works, which account to use, how interest compounds in your favor, what you are actually building toward, and why the order in which you save matters, are things most people were never taught in any structured way. This video covers all of it, starting with the account itself and ending with the single most important financial buffer you can build before you do anything else with your money. A savings account is a deposit account held at a bank or credit union that is designed for money you are not planning to spend in the immediate term. Unlike a checking account, which is built for frequent transactions, a savings account is built for accumulation. You deposit money in, it stays there, and the institution pays you interest on the balance over time. That interest is the return you receive for keeping your money deposited rather than spending it or holding it as cash. The interest rate on a savings account is expressed as an annual percentage yield, commonly referred to as APY. The APY tells you how much your balance will grow over the course of a year, accounting for the effect of compounding. Compounding is the mechanism by which interest generates more interest over time. Here is how it works in a savings account. Your bank calculates interest on your balance at regular intervals, typically daily or monthly, and adds that interest directly to your account balance. The next time interest is calculated, it is applied to your new, slightly higher balance, which includes the interest you already earned. Over time, this creates a compounding effect where your balance grows not just from the deposits you make, but from the interest earned on previous interest. In the short term, the effect is small. Over years and decades, it becomes significant. The key variables are your interest rate, how frequently interest compounds, and how long your money stays in the account. Traditional savings accounts at large national banks have historically offered very low interest rates, often as low as 0.01% APY. At that rate, $1,000 would earn 10 cents in a year. That is not a return worth discussing. The alternative that has become widely available and significantly more attractive is the high-yield savings account. High-yield savings accounts are offered primarily by online banks and some credit unions, and they pay substantially higher interest rates than traditional savings accounts, often between 4 and 5% APY during periods of higher interest rates, though rates fluctuate with broader economic conditions. The mechanics of a high-yield savings account are identical to a traditional savings account. The only meaningful difference is the interest rate. Because online banks do not carry the overhead costs of physical branch networks, they're able to pass more of their earnings back to depositors in the form of higher rates. There are a few practical considerations when using a high-yield savings account. First, these accounts are almost always held at a different institution than your primary checking account, which means transferring money between them takes 1 to 3 business days. That delay is worth being aware of if you need fast access to funds. Second, high-yield savings accounts, like traditional savings accounts, are federally insured up to $250,000 per depositor through the FDIC or NCUA, so the higher return does not come with higher risk to your principal. Third, some high-yield savings accounts have minimum balance requirements or limit the number of withdrawals you can make per month, so it is worth reading the account terms before opening one. Now, beyond the mechanics of the account itself, there is a specific goal that every savings account should be working toward before anything else. That goal is an emergency fund. An emergency fund is a dedicated pool of liquid savings set aside exclusively for genuine financial emergencies. A car breakdown, a medical bill, a job loss, an unexpected home repair. The purpose of an emergency fund is not to fund planned expenses or discretionary purchases. It is to absorb financial shocks without forcing you to go into debt, withdraw from investments, or make decisions under financial pressure that you would not otherwise make. The reason an emergency fund comes before everything else in personal finance is that without one, every financial plan is fragile. You can budget perfectly, pay your bills on time, and make responsible decisions every month, and then a single unexpected expense wipes out your progress and sends you into debt. An emergency fund is what prevents that from happening. It is the layer of protection that makes every other financial goal more achievable, because you're not constantly one bad month away from losing ground. The standard guidance on emergency fund size is 3 to 6 months of living expenses. That means adding up everything it costs you to sustain your basic life for 1 month, rent or mortgage, utilities, groceries, transportation, insurance, minimum debt payments, and multiplying that number by 3, 4, 5, or 6, depending on your situation. People with stable employment and predictable income can reasonably target the lower end. People with variable income, self-employment, or dependents should target the higher end. The goal is to have enough saved that if your income stopped entirely, you could maintain your essential expenses for that period without borrowing money or liquidating other assets. Building an emergency fund from zero can feel overwhelming if you focus on the full target number rather than the process of getting there. A more useful approach is to establish a starting milestone. $1,000 is a reasonable first target because it is achievable for most people within a relatively short period of disciplined saving, and it covers the majority of common financial emergencies. A car repair, an emergency medical copay, a broken appliance. Once you have that initial buffer, you shift to building toward your full 3 to 6 month target over time. The psychological value of having even a small emergency fund is significant. It changes the way you experience unexpected expenses from a crisis to an inconvenience. The most effective way to build an emergency fund is through automation. Set up a recurring automatic transfer from your checking account to your savings account on the same day your paycheck arrives, before you have the opportunity to spend that money on something else. The amount does not need to be large to start. Even transferring $50 or $100 per paycheck consistently adds up over time. The key is that the transfer happens automatically, so saving is not a decision you have to make repeatedly. It becomes a default behavior rather than an act of willpower. Where you keep your emergency fund matters. It should be in a savings account that is separate from your everyday checking account, so that the money is not visually mixed in with the funds you use for daily spending. Keeping it at a different institution than your primary checking account adds a small layer of friction that makes it less tempting to dip into for non-emergencies. It should be in a liquid account, meaning you can access the money within a few days if you need it. Emergency funds should not be invested in stocks or other assets that fluctuate in value, because the whole point is that the money is reliably available when you need it. A high-yield savings account is an ideal location for an emergency fund. It earns meaningful interest, it is federally insured, and it is accessible within a few business days. One common mistake is treating the emergency fund as a savings account for everything. Vacations, new purchases, and planned large expenses should have their own separate savings buckets, either within the same account using mental accounting or in separate dedicated accounts. The emergency fund is not a general savings pool. It is a specific, protected reserve for unplanned financial shocks. Blurring that line leads to a fund that gets depleted for non-emergencies and is not available when a real one arrives. Once your emergency fund is fully funded, the money does not stop working. It sits in your high-yield savings account earning interest, quietly growing, and doing its job by existing. You are not trying to maximize returns on this money. You are buying yourself financial stability and the ability to handle setbacks without derailing everything else you are building. That is the return. When something unexpected happens, and it will, you handle it, replenish the fund, and continue moving forward. That is the system working as designed.